Okay, now we go on to the free cash flow valuation model, a much more used model in practitioner standpoints. A lot of stock analysts will use a free cash flow model. The idea is we're looking at a company trying to come up with an intrinsic stock price, the true stock price, what a company should be trading for on the market. And we're going to be looking at the free cash flow left over. You can think of free cash flow as all the available cash left to be distributed to the shareholders. Okay? As opposed to looking at net income of a company, different companies will adjust their accounting differently. Some will use real fast depreciation, modified accelerated cost recovery systems, or straight line depreciation, which necessarily affects their net income. If we look at specifically free cash flow, we can compare apples to apples. And that's why a lot of analysts will use the free cash flow model. Now, just like the dividend growth model, we're going to take the present value of those future cash flows, but this time we're going to weight it by the weighted average cost of capital. Now, weighted average cost of capital, we'll look at this in detail in another chapter, but think of how much does it cost for the firm to be holding on to cash? Right? A lot of the money that's coming in is coming from either equity or debt. Right? So equity is going to have a certain cost to it, to hold on to it. If you're a shareholder, you're expecting a certain rate of return. So there's a cost, R sub E. And debt holders, bond holders, they're going to be paid a series of coupon payments at a certain rate. That's another cost. Depending on the weight of each of the costs, and by the way, we'll get into detail about this, but there's a tax deduction on debt for companies when they pay interest payments in the U.S. That's why there's a lot more debt out there than equity. But there's going to be an overall weighted average cost of capital, and that's what we'll discount the future free cash flows back by. So just like the dividend growth model, we're going to take the present value of all the future free cash flows going forward into infinity. We're going to assume the company goes on forever. Now, of course, we're going to have to assume a specific growth rate in the free cash flows so we can use this terminal formula, just like the dividend growth model. So looking at sources of value in a company, the value of operations is where the majority of the value is going to come from, right? Whether they're selling products or services, we're going to be looking at the series of free cash flow coming from those. Non-operating assets that we'll have to take into account are marketable assets like treasury bills, treasury notes, treasury bonds, and if the company has ownership of other companies, non-controlling interests in those. Claims on the corporate value, debt holders, if a company went bankrupt, debt holders would have the first claim, preferred stockholders would have the next claim, and anything left over would be up to the stockholders, be left to the stockholders. So a typical pie breakout of the sources of value in a company, value of operations is going to be the majority there. They'll have some in marketable securities, some cash parked that's safe, getting a slight return on it. And then if we look on the right for claims, generally equity is a large part of a company, whereas debt's slightly smaller, and preferred stock generally kind of a sliver of the claims on the company. So this is the data we're going to use for the free cash flow valuation. Free cash flow at time t equals 0. In other words, their last time we did a cross-section of the company, they had $24 million in free cash flow. We're going to assume that this company has a weighted average cost of capital of 11%, and we're going to assume that their free cash flow grows each year by 5%, and that it will grow each year forever by 5%. This company will have $100 million in marketable securities, $200 million in debt, and they have preferred stock of $50 million, and there's a total of 10 million shares outstanding. So to calculate the value of operations, this is just going to be the series of free cash flows going forward. So just like the dividend growth model, where it's P sub 0 is equal to D sub 1, one period ahead dividends, divided by R minus G. For value of operations of a firm, we'll say sub 0 at time t equals 0. That's one period ahead free cash flow divided by WACC minus G. Okay. So Same formula. We need G less than R. We need G less than the WACC. We need 1 period ahead, in this case free cash flow, and we need that constant growth rate in the dividends. As long as those are all hold true, we can calculate the value of operations today. So let's plug in the numbers. 24 million is our free cash flow at time t equals 0, but we need 1 period ahead free cash flow, so we times that by 1 plus G, so that's 1.05, divided by 0.11 minus 0.05, so total value of operations is 420 million. Now, we have to add back short-term investments, because that's part of the source of value in the company. So we add the 420 million to the 100 million, we have a total of 520 million here. We have to subtract out debt and preferred stock, so we could get the total value of equity in the company, which would be equal to 270 million. Now we divide that by the number of shares outstanding, which is 10 million in this example, and then we come up with a stock price of $27 for each share. Now let's look at an example of a non-constant growth free cash flow, which is more typical out there. In this case, always good to use timelines for these. T equals 0, we still have, this is a different example. So at t equals 1, we have a negative 10 free cash flow. At t equals 2, 20 million. And then t equals 3, 35 million. And then we're going to assume the free cash flow goes constant at 5% thereafter. So we're going to be able to use that generic formula where V sub operations at period n is equal to free cash flow period n plus 1 divided by the WACC minus G. So we'll look at the value of operations at t equals 3. We'll set it equal to the free cash flow at time t equals 4 divided by the WACC minus G. And then just like the dividend growth model, we'll take the present value of all those future free cash flows to get a total value of operations at t equals 0. So here we go. If we take the value of operations at period 3, set it to free cash flow, so 4 divided by WACC minus G. Free cash flow at 4 would be equal to the free cash flow at 3 times 1 plus G, which gives us 36.75 divided by the WACC, which is 0.11 minus 0.05, and this comes out to 612.5. So in other words, when we assume free cash flow is going to grow at 5% to t equals 4 to t equals 5 and beyond forever and ever, this number tells us that the present value at t equals 3, the present value of all those future free cash flows is equal to 612.5. So value of operations at period 3 is equal to 612.5 million. So if we wanted the value of operations at t equals 0, we need to take the present value of all the future relevant free cash flows, which is minus 10 in period 1. We divide that by 1 plus the WACC raised to the 1, so 1.11 raised to the 1 plus 20 divided by 1.11 squared plus 35 plus 612.5 divided by 1.11 cubed. And that comes out to 480.67 million. Okay. So that would be the value of operations based on the series of cash flows and the fact or the assumption that the free cash flow increases by 5% each year in perpetuity. So we take the value of operations, we add back the short-term investments, subtract out the debt, subtract out the preferred stock, get a total equity value of 330.67 divided by 10 million shares. We'd come up with a share price of 33.07. Now, if you looked on the New York Stock Exchange and saw that that firm or that stock was trading for $40 a share, you could say, well, based on my model, if you have faith in this model, that it's overvalued, and maybe you should short it. On the other hand, if you see a stock, it's trading for, say, $28, you just got a value of $33, you'd say, this stock is underpriced, it's a good buy, I should go for it. So multiples, we'll cover this in a future chapter. It's definitely kind of a second go-to model. A lot of times people talk about PE multiples, how many times the stock price is compared to the earnings that are being evaluated. One more model I want to cover in this chapter is preferred stock. Preferred stock, it will sometimes just pay the same amount over and over again without increasing the dividend payments, right? So if you have an example where you're getting preferred stock $5 dividend payments, and your required rate of return is 10%, that means t equals 1, t equals 2, t equals 3, and beyond into infinity, you're going to get $5 every period in perpetuity. Well, we can just use our perpetuity model then. We can just say the stock price is equal to the dividend divided by R. So 5 divided by 0.10, that stock's worth $50. Okay. And I have another example here. Let's say the preferred stock pays a dividend of $2.10. The required rate of return 7%. Just take $2.10 divided by 0.07. And we'd see that it comes out to $30 per share.